Welcome to the Corporate Treasury 101 podcast. This is the first snippet of our amazing and extensive conversation with Agustin Mackinlay from Kantox. Agustin is a senior financial writer at Kantox, a former lecturer and a fellow podcaster. He is a fount of knowledge, particularly when it comes to currency management, foreign exchange risk management, FX trading, and so on. Hussam and I simply couldn't stop asking him questions, and we can feel how passionate Agustin is when we listen to him. In the episode of today, expect to learn what is currency management, what are the instruments used in currency management, what is a hedging strategy and a hedging budget for companies, how industries impact companies' needs in terms of currency management, what are and who are the main actors when it comes to that endeavor, and much, much more. If you like the episode, the best thing you can do is to share it, submit a review on your favorite podcast app, and subscribe to the podcast. This would mean the world to Hussam and I, and would help the podcast a lot. With all that being said, please welcome Agustin Mackinlay. Hey, Agustin. Thanks a lot for joining the podcast. Can we maybe begin with you introducing yourself and explain us what you do?
Well, hey there. It's great to be here. My name is Agustin Mackinlay. I'm the senior financial writer at Kantox and the host of Currency Cast. As both a financial writer and a creator of a podcast, well, my work involves writing reports and different pieces of research. And, well, I'm proud to say that we have here treasurers guided through the process of currency management in all of the different aspects. And it's really exciting to be here today to talk about all of this.
Very excited as well. And I already heard quite some terms that I can't wait to break down. But maybe before diving into this, can you explain us what Kantox does?
Right. Look, Kantox is creating a new software category. We call it currency management automation. We're going to discuss, of course, all of these topics, but it involves in providing treasuries with mostly automated tools, software tools to guide them through the entire process of currency management. And we can break down that process in what we call three phases: a retrade phase. We're going to, of course, discuss that, where it starts with using a foreign exchange rate to set the price of the goods that you sell. If, for example, you can sell them in overseas markets, obviously that is going to involve a currency rate, but you can sell it in domestic markets if there are imported components. That also is going to involve a currency rate. Then there's the process of the trade phase itself that involves executing what is in our case, forward currency transactions. And of course, we're going to discuss them in more detail, all the way to the post-trade phase that involves payments and collections in foreign currencies. Now, we'd like to emphasize that this is an end-to-end approach. And beyond all the technicalities, Hussam and Guillaume, what we aim here is to provide answers for concrete business problems, right? And so, for example, it's interesting that the Chinese have, when they express risk, they use two characters: danger and opportunity, right? And yes, of course, there are some aspects of danger in currency management. We want to emphasize the aspect of opportunities, right? We want to provide treasury with tools to become more strategic, to take advantage of the opportunities that currencies bring. And we call that embracing currencies very optimistically.
Love the approach. So I think you also guys have a podcast, right? I definitely want to break down everything, quite some actuality and news to cover as well. But beginning with the Currency Cast podcast, can you walk us through what you do there and what it is about?
That's right. We started the Currency Cast podcast back in 2022 as a way to create awareness about that category that we call currency management automation. And well, it involves a master class that I'm grateful to them for calling it that way. So usually we present in a relatively short episode one or one element of all that so set of complex steps that are included in currency management. And so that's what we do in Currency Cast, and we're very excited to continue with it for the foreseeable future.
Very cool. Very cool. Augustin, thank you so much for coming on. So let's get into the nitty-gritty, Augustin. So you mentioned a few times currency management. Could you define currency management as seen by Kantox?
Right. Yes. Excellent question. Well, look, currency management is the process of using foreign currencies in commercial and also financial operations. Commercial operations, as I just mentioned, right? If you're going to sell in overseas markets, in Canadian dollars, in Thai baht, in Brazilian reais, then exchange rates and currencies are going to be involved. Or if you sell in domestic markets, but say you're selling British pounds, furniture that you imported from China, it's going to involve the Chinese currency, British pound. The entire process starts with pricing, but as I said, there is also the risk management a part of all this. Not the only one, right? People tend to put to give more importance to that risk management, which is of course very important, but it's not the only one. There's going to be also the process of payments and collections in foreign currencies, and all of that must be included in what we call currency management.
Do you define those differently between risk management and currency management, Augustin?
Well, yes. As I said, pricing with an FX rate is a key component in currency market. In currency management, we've got to see some examples, I think, a little bit later on. And the process of risk management also is usually understood as executing hedges. And of course, we need to define what that means. But at Kantox, we have maybe a broader view of all that process. So, for example, there are ways to manage risk, the underlying risk in currencies without executing hedges. And all of that is going to require a slightly, maybe different approach that the one that is emphasized, right? Mostly executing those currency hedges. And so it involves more processes, more possibilities. In fact, it's a world of opportunity that opens up for treasurers, again, to act more as strategic players within the company and allowing the firm to take advantage of those currencies to maybe enhance the firm's competitive position. And why not securing budgeted profit margins and even perhaps making a contribution towards, well, enhancing the value of the firm. Why not?
No, very clear. I'm looking forward to digging into that. I heard some words that Guillaume and I and our listeners love, like hedging. This is a hot topic for us on the Corporate Treasury 101 podcast. So looking forward to touching that again. But before we get into that, could you give us some examples of situations of where companies or corporates would use currency management exactly?
Well, yes. So say that we're dealing with a US-based company that has an order to sell in, say, 100,000 euros worth of goods. But the key thing is that the settlement of that commercial transaction, right? Because it's a commercial transaction, is going to be, say, in 3 months' time. So what's going to happen? Between the moment the transaction is agreed and the moment it's got to be settled, that it's settled in cash, right? There's going to be a shift in the exchange rate. As we know, exchange rates change second by second, right? And so that is going to involve a number of processes, and of course, not to depend on the type of companies, the type of pricing characteristics, some face dynamic prices that change over time. Some companies, on the other hand, would like to keep stable prices for, say, an entire campaign or budget period, and others still decide to keep steady prices for as long as possible. They're going to create different type of situations that we're going to require different types of currency management.
I wanted to dig into the purposes of currency management. And it's basically to enable international trade, right? As long as you have to deal with other territories, countries that have different currencies, not only will you need to exchange your own currency against or with the other one, but also hedge yourself against certain aspect of currency risk management, as you mentioned earlier. Pretty clear. What are the instruments typically that we find in currency management and then currency risk management, Mark?
Right. Well, yeah, I would add to what you just said that, yes, we are used to think of currency management in terms of commercial transactions, right? Mostly buying and selling goods and services, and that you're perfectly so right to emphasize that. But basically, there could be a financial type of exposure to currency risk, which is, so for example, a company makes a loan to subsidiary in a foreign currency. And this is not a commercial type of transaction, but it's going to involve currency risk as well. Right? So there's commercial type of exposure and perhaps a more financial type of exposure. By the way, it's very exciting that right now we're starting to get clients from the fintech space, fintech companies that fund themselves in one currency and issue loans in another currency, which also creates tremendous opportunities for them and for us to help them manage those currencies and that currency risk. Now, with regards to the tools that are used in currency management, well, I think most important ones involve the spot market operations, forward markets operations, but also options and why not futures. Would you like to discuss those?
Absolutely. Please, let's dig into this. So what are the difference between all of those instruments? How do you use them and in which situations exactly?
That's right. Look, a spot transaction, as the name implies, is a transaction that is, so for example, if I got to buy one currency and paying in another one, that takes place, the settlement and the delivery take place on the spot, right? That's why it's called a spot market transaction. Now, it's not exactly on the spot. Why? Because usually it takes about 2 working days to be settled, but mostly it's a spot market transaction. The delivery and payment take place almost immediately. In fact, for euro against the dollar, which is the most widely traded currency pair, it takes only 1 working day to be settled and delivered. There are, of course, other types of foreign exchange transactions that help you manage currency risk and currencies in general. And the most widely used here for us and in the world is so-called forward market foreign exchange transactions. And they also involve a currency that is going to be sold against another one or bought against another one. But the key difference is that settlement and payment do not take place on the spot. They're going to take place at a date in the future, right? That is agreed upon by both participants. And that creates at least 2 important differences with a spot transaction. The moment, of course, time is involved, right? You may agree to have delivery and payment take place 2 weeks' time, in a month's time, in 6 months, in 1 year. But the minute time is involved, interest rates are also involved. And that is going to add some complexity to the issue. Also, you need to take your creditworthiness into consideration, right? An American president said, trust but verify, right? In order for you to to be able to execute such a forward transaction, you need to make a good faith deposit, right? Call it a collateral amount that needs, or cash that needs to be set aside in order to avoid bad surprises. Right?
Makes a lot of sense. I like that the finance people have quite an understandable jargon, right? Spots, it's because it happened on the spot. Forward, you look forward to transaction. Makes a lot of sense. You mentioned a term that I would like to break down a bit, which is currency pair. I think it's quite a simple one, but can you break it down for us, please?
That's right. I mentioned, I think, the most widely used currency pair is the euro and the dollar. Right?
Mm-hmm.
Usually it's expressed in, you will see it written as EUR USD. What does that mean? It means the amount of US dollars for 1 euro. That's a currency pair. Could be expressed the other way around, right? Of course, the amount of euros for 1 US dollar. It's just a convention. It's exactly the same, but these are the conventions, and the most widely used currency pairs. They involve, of course, as I said, the euro and the dollar, but also the euro against the British pound, the dollar against the Japanese yen, and more and more, of course, as we're reading the news, we're seeing what's going on with China. Little by little, the Chinese currency is gaining momentum, meaning that currency pairs involving the Chinese currencies are also going to be more widely used going forward.
Okay, so currency pair just simply refers to two different currencies at which you would look for a spot rate, a forward rate, or you just look at what is the exchange rate between those two in the time.
That's absolutely the case, yes.
Makes a lot of sense. Agustin, that's super clear. That we have a term that we hear sometimes, which is trading currencies when it comes to currency management. Can you explain us what that means exactly?
Well, yes. Trading currencies, it involves, of course, buying and selling one currency against another. And maybe an example will help us see that. So let's say that you're a Norwegian company and you wish to buy, for example, 10 million US dollars. Now, you're going to go to a foreign exchange dealer that is going to show you two, not one, but two currency rates. Right? It's got to show, so for example, 8.55 Norwegian krone per dollar and 8.5530 Norwegian krones for $1. So what's going to happen here is that at any time, there's going to be people interested in buying dollars and in selling dollars. But here, if you're going to buy dollars, in this case, you got to pay 8.5530 Norwegian krone. And if another company wants to sell those $10 million, it's got to get paid 8.55. The difference is, of course, those a $10 million amount, it equals 30,000 Norwegian krone. That's how dealers make money. That's how currency trading takes place. Could be on a spot basis or on a forward basis. Now, we are at Kantox a little bit keen to not to overemphasize the term trading. Of course, it is used, right? And we do it all the time, but it has maybe a speculative connotation, right? Retail traders buying and selling. And we like to think of currency management as the opposite of speculation, right? Yes, of course, it is going to involve that trade, but which we're keen not to overemphasize that aspect. It's just one in the chain of events that, or the workflow, right, that starts from pricing and then to payments.
Super clear, Augustine. Thank you so much. There's a couple more financial instruments that we had covered before in Corporate Treasury 101. So we talked about spots and forwards, but we also have mentioned things like swaps and options. Are those also used in currency management? And if so, how?
Yes, absolutely. Because they're used, swaps and options are widely used. There's another one. Just let's briefly break them down all one by one. So a swap transaction is a transaction in which you buy and sell the same amount of a currency against another, but with different value dates. What's a value date? Is the moment in time that a transaction is going to be settled. We saw that in spot market transactions, that is the spot, forward transaction that takes place at a date in the future. So swaps are very useful. So for example, if you have a forward transaction in place, say to buy €1 million against $1 million against euros, but you realize that you need in 2 days, say $100,000. Well, what you could do is here execute a swap transaction whereby there is what is called a near leg, in which you buy the $100,000 that you need for settlement in 2 days, and at the same time, you sell those $100,000 with the value date of the original position. And look at what you achieve. You're going to adjust your forward transaction, right, to the needs of the commercial hedging operation. And at the same time, you're going to have the cash at your disposal that you're going to need in 2 days' time. Very, very useful type of transaction. Here, of course, there's going to be a foreign exchange gain and loss depending on the change in the exchange rate. But still, it's a very, very useful type of operations, and we do that all the time. Options, on the other hand, it's an altogether different animal, right? Yeah. When you have the option to buy one currency against another, well, as the name indicates, right? You have the option to decide whether to go ahead or not with that transaction. And it's going to depend obviously, on the exchange rates on the day of the settlement. Is it too good to be true? Well, yes, in a sense it is. Right? So that's why option buyers need to pay what is called a premium to options. So it's a little bit like in a regular insurance policy. You have the right to make a choice, but against that choice, you needed to come up with a premium, a payment, right, immediately done. So maybe there's an issue here with options that we don't do at Kantox. We don't work with options, and it's the pricing of that premium, right, of that right to decide whether or not to buy or sell. Well, it can be the result of complex mathematical calculations that sometimes in situations where there is more complexities involved, maybe it's not as transparent as forward our contracts are. So that's why we don't use them at Kantox. We like to say that we think forward, right? We use forwards mostly, and of course, and swap transactions.
So is a swap is like if you had a forward already in place, but for some reason you need it earlier. So it's kind of like an emergency options contract. If you knew you needed it before, perhaps, or you had a higher risk of needing it before, you might have taken an option and paid for the premium. But would a swap then be more expensive than just getting an options every time? Or
no. Well,
why would you pick one over the other?
Well, you're absolutely right to say that the swap allows you to adjust your position, and it's so useful in that case. Now, we call that to draw on a forward, right? To use the cash that you need. Why is it Hussam, so useful? It's because what you see in textbooks is, of course, the settlement date of a commercial transaction by miracle, exactly matches the settlement date of your corresponding forward transaction. Maybe we'll discuss that in more detail. But in real life, it's not the case, right? These adjustments need to be executed. It's not always the case that the settlement of your commercial transaction exactly match the value date of your forward transaction. Now, the reason why we prefer swaps and forwards is mostly because of transparency reasons. There is no the price is completely transparent. You can see that on Bloomberg, on Thomson Reuters. The information is widely available, whereas options are more of a could be, right, depending on their complexity, involve a little bit less transparency than we would like, at least for our clients.
Very, very, very clear. And there's one word you haven't used yet, Augustine, that comes up a lot in Treasury, which is risk appetite. And my journey into learning about Treasury, Guillaume has taught me a lot that treasurers are always thinking about risk. So how does that play into all of this?
Right. Look, it's of course a fantastic point there. Risk appetite is the reflection of a treasurer's view on the underlying risk in currency management. We tend at Kantox, as I think I mentioned a couple of minutes before, to avoid any type of speculation. That's really, really one key message that we always share with treasurers, CFOs, if needed with CEOs, board of management, or board of directors. No speculation is, in our view, the best. So the best way to manage currencies, and that is going to involve, of course, as I think you are hinting at that, right? Your own views, markets, well, where are they headed to? Is the exchange rate going to go up or down? But that is going also to involve perhaps your own biases, right? And there's lots of those psychological biases that the treasurers have, that you have, that I have. And one way to deal with those biases, right, is with automated tools that are going to allow you to exclude as much as possible any possibility of engaging in speculation, right? And that's why we use that term and that concept of automation to deal with that potential risk.
Agustin, we really like to go down the rabbit hole. And so you mentioned two things here. The commercial transactions that may happen at a different moment that it was foreseen, and the risk appetite. From what I understand on the different instruments you describe, would you rather use like not flexible instruments and probably therefore a bit cheaper for payments over which you have total control, and more flexible instruments for collections, linking back to those swaps, because those collections can arrive at a different time than it was initially planned, right? So is there such a thing in terms of strategy, and we're going to come to it, but hedging strategies, or those that have nothing to do with it?
Well, hedging strategies is a big one. We tend to use the term hedging programs at Kantox, but yes, those hedging programs are going to go, as I said, so are going to include all the phases, and the phases include payments and collections as well. But note, Guillaume, that forwards and swaps, so swaps could involve spot and forward transactions. They could involve two forward transactions. And so there, in our mind, is roughly the same instrument that we're talking about, only with different value days. So it's the one that we prefer. It's the one that we tell companies to use. It's the most widely used of all, by far, by the way, in terms of currency management. So we don't see there enormous differences in payments and collections, we always use spot payments, forwards, and of course, those swap transactions.
Very clear, Augustine. Thank you so much. Can you take us further then into, as I mentioned at the start, our favorite topic, which is hedging and these hedging programs? So when we talked about hedging on Corporate Treasury 101, when Kim first explained it to me, talked about currency hedge, FX hedging and interest rate hedging. So focusing on the currency or the FX hedging specifically, what are those hedging programs? And can you give us like examples from the real world?
That's right. Well, look, let's explain, if you will, a hedge here relatively in relatively simple terms. A hedge is, to go back to that example of a US-based company that has a agreed up on a sale of 100,000 euros, but the settlement's got to take place in 3 months' time. What you do is to hedge that transaction, that is to protect against the risk in that transaction, right? Transactional FX risk. But at the same moment, same date that that operation was closed or was agreed upon, what you got to do is you're going to sell the same amount of euros in the forward markets. With what valid date? With a valid date that, if possible, matches the date of the settlement of the commercial transaction. And look at the magic that is going to operate here. What happens on the date of the settlement of the two transactions? Because there's a commercial one, there's a financial one that you're going to do with a bank, right? You're going to get paid your 100,000 euros from the commercial transaction, and you're going to wire that amount to the bank, right? Against that amount, the bank is going to deliver the value of the corresponding value in US dollars. Note that value was agreed upon as the transaction was also agreed upon. So there is no transactional currency risk other than the impact of interest rate differentials that we may discuss a little bit later on. But also note that allows us to define a hedge with more precision. Right? The hedge is, in fact, it is the creation of taking a financial position in a so-called derivative instrument, in this case, a forward currency contract, whose value is going to shift in exactly the opposite direction as the value of the commercial operation. So, for example, in this case, if at settlement, the exchange rate between the euro and the dollar goes down, right? There, from a commercial point of view, you've got to get what is called an FX loss, right? The commercial transaction, when translated back into dollars, is going to be of a lower value. But what happens when the value of your financial transaction? There is got to go up in value because you sold it at a higher price. So it's an offsetting impact that defines the precision of a hedge. Now, there are, of course, different, people call them strategies, or rather use the term programs. And mostly what they involve are, well, different types of programs according to the pricing characteristics of your business. It's not the same if you're facing what we call dynamic prices, or prices that are updated all the time, like in the travel space, right? OTAs, online travel agencies, are going to face prices that are second by second, and they change all the time. Or a situation in which you wish to keep, say, a steady price, a fixed price on a catalog for 1 year, say, or one budget period, or one campaign period, right? Could be less or more than 1 year. And you have the ability to reset your prices at the onset of a new campaign. Still, another possibility is those firms that, perhaps for competitive pressures, need to keep their prices steady for more than 1 or 2 campaigns. In fact, for as long as possible. And it's not to call for different hedging programs, and that's where things get, of course, very, very exciting.
Can you, in terms of hedging strategies, is there such a thing as hedging only a proportion of your commercial transaction? And by this, I mean, so the example you mentioned with the 100,000 USDs, could you hedge or like contract with the bank forward only for 50K, for instance, because of this pricing incentive that you don't want to pay too much for the cost of hedging, but you also want to have a little bit of certainty? Is there such a thing, or that doesn't exist?
Well, Guillaume, you just described the process of protecting a budget rate, right? That's what happens in budget. So maybe budget hedging is not the correct expression, but when you want to protect the entire budget for 1 year, you're going to do exactly as you're implying. You're not likely, or at least we don't advise companies to take right at the start of the budget period a hedge, right, for the entire budgeted forecasted amount. Why? Because it's going to create forecasting risk, right? Here, what if COVID hits you in the midst of the budget period, right? You will end up in this case being what is called overhead. You will have a large financial transaction, but the size or the value of your commercial transaction might be, in this case, lower due to COVID or whatever, the economic crisis, etc. And that's exactly what we tell companies to do, as they are going to undertake a program to hedge their budgeted exposure. Now, very important that, because here, this is a fantastic example, Guillaume. Thanks very much for citing it, because it leads to the difference that we see in currency risk management and hedging. Let me explain this. So say that just as you imply, you don't want to hedge the whole of the expected or forecasted budgeted exposure, but say maybe 20% of it or 40% right at the start. That's a prudent way to deal with things, and it's got to reflect your degree of forecasting accuracy, right? But you don't want either to have the rest of the exposure completely left to possible fluctuations in currency. So what is that we advise companies to do then? And we execute automated hedging programs. So that is to set for the remaining part of the budgeted exposure what is called conditional FX orders. I'm sure you've heard about conditional FX orders. They include so-called stop loss orders and take profit orders. In this case, what we're going to tell management is, look, for the remaining exposure that you didn't want, perhaps for very good reasons, to hedge 100% right at the start, let's put in conditional FX orders. How do we calculate them? Well, in such a way that, say that you're going to divide the remaining exposure in 3/3, right? And so you're going to put 3 stop loss orders in place, right? Such that if they are executed, if the market moves not in your favor, right? So there is a worst case scenario in currency markets, the average of these 3 stop loss orders exactly matches your budget rate that you used in setting prices. So that's one way, you see, Guillaume and Hussam, one way in which currency risk matters, because we're managing risk here, right? We're not letting the company have unmanaged exposure to currency risk. But we're not necessarily executing hedges. We are monitoring markets, making sure that you're still actively managing your exposure to currency risk, but maybe not executing hedges all the time. That could be also for interest rate reasons, pretty expensive. So, and now I get enthusiastic about this because look at what's going to happen there. You're going to get, as a treasurer, right, to the extent that this stop loss order unexecuted because markets maybe are not very volatile, perhaps they move in your favor. So, of course, you could put also take profit orders, right, to take advantage of favorable moves. But to the extent that your stop loss orders are not executed, you gain time. And time, as I'm sure you've seen that in many talks with treasurers and with people in treasury, time is the most precious asset for the treasury team. Also, it's going to give them the possibility to do lots of things. One thing is, of course, to update, to fine-tune, to improve their cash flow forecasts. So as they do that, and they do that with the help of information that comes from the real world, it's not just forecasts. Now they got to be able to see what's going on in the economy, in the business, in the sales, in their purchases, and they're going to fine-tune their forecast. Now, as you fine-tune your forecast, to the upside or to the downside, you automatically adjust the level and the size of those conditions so that you make sure that the process improves as time goes by. Note also, and again, so displaying my enthusiasm here, note that also as time goes by, you might discover or find what is called netting opportunities. I'm sure we'll discuss that a little bit more, but netting opportunities is, hey, why would I execute a hedge if maybe a subsidiary has a trade in the opposite direction? And even more to the point, but that involves a pretty technical point that is perhaps best left for a little bit later on. There is the interest rate impact here. If interest rates are not in your favor, let's discuss that in a couple of minutes, but here, delaying that hedge execution with the help of conditional orders is going to allow you to lessen the impact of those unfavorable interest rates. So lots of things are there to do, as you can see, depending on the type of strategy or program that you wish to implement.
No, that's very apparent, Agustin. Thank you so much. I mean, there's so many different strategies you can put in place. And you've taken us through lots of them. I'm sure there's way more. You mentioned earlier about online travel agencies and how they have, a certain need because of the environment that they're in. That raises the question of, do industries have different strategies that are very common to them? Largely around, like you mentioned, online travel agencies would be making transactions in seconds in different currencies, where factory, which is making one big bulk order of a certain raw material every month, would have perhaps a different strategy in place. So how does it vary by industry? And what are perhaps the extreme cases on each side?
Yes, absolutely. So a great point there. Yes, it's in our view, the main point that calls for different type of strategies or programs is, we call it the pricing parameters of the firm. But pricing parameters might be a little bit confusing, so let's call it the pricing characteristics of the firm. Do you face dynamic prices like the OTA, right? Or do you keep your prices steady for one campaign, right? Or do you keep your prices so as steady as possible for as long as possible? That's the key element. Another element is the difference in interest rates, as we're going to explain a little bit later. But to go back to the example of the travel sector, this is a fantastic one. It's perhaps the extreme one, right? In terms of dynamic prices. Now, there's geolocation services, payment apps, algorithms that track demand and supply changes in seconds. That has turned the prices in travel incredibly dynamic. They change really literally minute by minute. So it's very important, very difficult there, or almost dangerous to take a budget hedging approach, such as the one I described a little bit earlier on, right? Because you would have the forecasting risk would be extremely high, and you would take perhaps too much risk. What we do here is we advise companies to apply what we call the micro hedging program for those firm sales or purchase orders. You could, for example, buy hotel capacity in Thailand and sell packages in Canada, right? It's going to involve so currency risk on the buy side, currency risk on sell side. It's going to involve many times small transactions, right? And it's going to involve perhaps many different currency pairs. So that's almost, or that is impossible to manage manually. What you want here is to, what we call, to aggregate those individual pieces of exposure, so that instead of executing a hedge for, say, a couple of £1,000 or dollars, to have a little bit more of an aggregation, and then only you would execute the hedge. Note that this requires all the time that you recalculate the value of that exposure with the new piece of information, new sales order or new purchase order that comes in. And it is absolutely possible to do it manually. You really need here the help of software tools to handle all of that.
Super clear. And so linking to those software tools, Agustin, and also in more generally the currency management world, who are the main actors, actually? You mentioned, obviously, the corporates who are in need of FX deals, right, to cover their commercial transactions. Who else is out there?
Our corporations are by far the biggest users of currency management solutions, both for the commercial type of exposure to currency risk, or national type of exposure, but you could also mention currency dealers that have a very useful function in finding all those buyers and sellers that allow you to create a lively market. And in that regard, by the way, there's an interesting development. Well, it's not new now, but it has flourished in the past, say, 2 or 3 years. And it's called we call them multi-dealer trading platforms, such as 360T. So what they enable you is to automate what we call the trade part, right? The execution of that forwards or spot or swap transactions. The treasuries now have the tool to automate all that part of the process, right? The trading phase itself, thanks to those platforms. By the way, those platforms will give you, will have lots of features. One of them is called best price execution, which is really interesting because it's quite an amazing sight, right? When you see those currency rates fluctuating second by second, not only second by second, but also with the different banks that might have slightly different rates at which they buy and rates at which they sell. So the software solutions there from those currency dealers, those multi-dealer trading platforms, automatically make sure if you're interested in getting the best price, you will get it. Not always, not everybody wishes necessarily for the best price execution. For example, if you're doing business with a bank in other parts of the company, so in raising capital, in managing other parts of risk, take interest rate risk or commodity price risk or whatever, you might want to channel your FX orders to that particular institution, but you have the choice to do that. Right? It's a way to automate all that trade part. And of course, banks are on the other side, the very big players here, because what a bank has is, well, we know that, right? Contact with anybody, a given amount of currency, and others who want to sell that amount of currencies. Of course, they do that in money market instruments, in whatever, and in equities, and on a spot basis, on a forward basis, on an options basis. So banks are very important here, of course, as they have all those contacts that enable to create what we call liquidity, right? Meaning that you will have at all moments, 24 hours, 7 almost, a price to execute your desired transaction. So these are the three big players here: the dealers that put the banks and the corporates in contact, the corporates that use the currency markets for for currency management purposes, and the banks.
I can't help myself but to ask then. I mean, we have a whole question on what those Kantox do and the way you guys work, but where does it sit in all these Kantox? We have three main actors: corporates, FX dealers, and financial institutions. And therefore, for my curiosity, where does Kantox fit into all this?
Right. Look, what Kantox offers is, as I said, a set of automated software solutions to handle that end-to-end of management. It starts with all the way from pricing, and then so channeling that to the trade phase and then the post-trade phase. We call that end-to-end because and that's really, really important here. Some people argue for automation as what is called discrete automation, meaning you solve one particular issue, but we really emphasize end-to-end automation, meaning integrate all the parts. To give you an example, if you are saving a few what's called pips, right, fractions of those, the difference between the price at which you sell and which you buy, you may save them by automating trade phase of the workflow. But what if you're not integrating the pre-trade phase? That involves the process of exposure collection that we might discuss, right? But if you don't have a proper integration between those two, what you save on trading costs, you may lose on poorly managed currency risk. So that's what we do. Now, those solutions are based on a technology that you want to go into that discussion. Well, it involves mostly APIs, right? Application programming interfaces, a fantastic piece of technology that enables us to provide those solutions.